Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage. He was identifying winning stocks with massive uptrends, like Riot Blockchain before it shot up 10,000%, Digital Turbine before it shot up 789%, Overstock.com before it shot up 1,000%. This power gauge comes from the legendary Mark Chaikin. Right now, you can get a free in-depth look at how his power gauge system works. A way to type in any of the 4,000 different tickers and see exactly where a stock is most likely to go next in any type of market. Simply go to chaikintrial.com for your free look. Again, that's chaikintrial.com. Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is the 22nd of March, 2022. So 32222 sounds like a pretty good number to me. So good that the S&P is now at a 1 month high today. You would never know it if you read the headlines. We're going to talk about the markets today and do a little deep dive. I got some 4 amazing charts for you that show really how great of a buying opportunity this is over the long term. We're going to talk about Bitcoin, big move by Goldman Sachs in the crypto markets yesterday. We're going to talk about oil rallying yet again. Battery costs are going through the roofs. And the China crash that we just saw in tech stocks, reminiscent of 2000 in NASDAQ? Great buying opportunity? Possibly. All coming up right now on Making Money. Welcome again. This is Matt McCall. Thanks for joining me. It is the 22nd of March here, 2022. It is a Tuesday. It is a beautiful day outside here. I'm staring at the ocean on the right-hand side. And things are looking good. And the other screen here, I have the S&P 500 at a 1 month high. And I know a couple of weeks ago, people thought I was crazy saying buy into this when the war was just starting, or the conflict, whatever you want to call it, going on in Ukraine with Russia attacking them. We had inflation at 40-year highs. We had interest rates breaking out to multi-year highs. We had all this negative news surrounding the markets. And again, I was saying stay calm. These are the times where successful long-term investors really pay their dues. This is the hardest thing to do. Whether you're fully invested and you have to hold on through these downs before it comes back up, or whether you have some cash on the sidelines, you have to buy when the media and your friends and your family and your coworkers are panicking and selling. It's so easy to be sheep and follow the rest of the crowd. But that's why the rest of the crowd says the stock market's rigged. You can't make money in the stock market. It's only for the wealthy. That's a bunch of baloney, folks. It is the greatest wealth creation tool out there for the average American. For the average American, not for the wealthy, for the average American. The wealthy can go buy hundreds of acres or thousands of acres of land somewhere. That's not easy to do. Start businesses, not easy to do. But if you have a huge bankroll, it makes it much easier. If you don't, and you're living paycheck to paycheck or putting a little bit away for your kids' education, how do you grow that money? The best way to do that is investing in solid, long-term, innovative companies. It's been done for years, decades, really over the last century. Investing in good companies and being in the stock market is one of the greatest ways to grow that money you work so damn hard for. It should work for you. You're working for the money. Now let that money you've earned work for you, folks. So let's just jump in and take a look at the S&P 500. I think it's important to take a look at what we're at right now, because I just mentioned. You can see here, this is the SPY, the SPY, ETF that tracks the S&P 500. It's up about 0.8% today, 3.7 points, as you can see in the upper right-hand corner. And very easily you can see, again, right here, the best level that we've seen in a little over a month. Also, it's tough to see, but these blue and these red lines, the blue line is a 200-day moving average. The red line is a 50-day moving average. The last time we were above both of them was early January, when we were only about 2 or 2.5% off an all-time high. We're back above both right now. Again, the negativity that's in the headlines, and yet stocks are trading at a 1 month high. It is quite fascinating to me that, I say this all the time, so maybe it's not as fascinating to me, but it's just when the mentality of investors, because And it's not investors' fault, folks. It's not their fault or your fault or anybody's fault who gets spooked. Heck, I'm a human being. I hate to see my portfolio go down. Nobody likes it. But I've lived through so many ups and downs over the last 2+ decades of being in the market that I realize. And going back to, I really started buying stocks in about 99-ish, 98, 99-ish, really in earnest when I was in college. And just think about that. I lived through this huge melt up at the end of the tech rally, then the huge sell-off, the tech bubble. Then we had the big rally after that. Then we've had a couple more sell-offs. We had 2008 financial collapse. And then a big bull market rally. It lasted over 10 years, a couple of pullbacks along the way. Then we had the pandemic, the fastest bear market ever. And then the fastest bull market right after that for the market to double. And then right now, we're dealing with a correction. I mean, so many things have happened. And it's people say, well, you've only been in 20-some years. We've lived through a lot in the last 20-some years when it comes to the market. So we had the best week last week in the S&P 500 since 2020. And that's why you can see that it ran up to a new 1-month high. Well, heading into yesterday, we had 4 consecutive days of at least 1% gains. And if you go back to 1928, this is the 15th time that it's happened, so nearly a century. So it doesn't happen that often. I have a chart here for you, and it shows the S&P 500 and shows what happens when there's 4 consecutive trading days with gains at least 1%. Again, going back to 1928 to 2022. As you can see in this chart, it's broken down. It shows if it was in a bear market, it says no, yes. So it shows you if it's a bear market or not. And then it shows you what the market did 1 week after this, 1 month, 3 months, 6 plus 9 months, and a year. I'm a longer term investor, so let's look at a year. If you remove these 2 years that during the Great Depression, 30 and 31, you can see, look at the gains every single time outside of that. Since 1931, when this occurs, every single time but one. So it's 12 out of 13 times we're up. The worst performance at 1 year later was a negative 6.6%. But look at the gains. I mean, the worst gain was 7.6%. I mean, huge gains, folks. Typically, when we see something like this, where these 4 up days of at least 1%, the reason that we see the market much higher a year from now, and even look at the chart shows 3 months, 6 months, 9 months, the odds are you're going to be higher in all the time periods shown. The reason that this typically happens, because if you have money coming in 4 consecutive days like that to move the market at least 1%, that's usually a start of something big. That's a start of big money moving to the sidelines, and it doesn't end in 4 days. It is just the beginning. So that brings me to the next chart here. And this shows cash levels. As you can see in the chart, all the bar chart we have going on here, cash levels, this is according to a survey of the Bank of America Global Fund Manager Survey. Came out last week. I talked about it last week. March 2022, it comes out every month. So March 2022, this month, as high as 5.9% in cash. It matches going back to April of 2020. We know what that was. That was the bottom of the market after the pandemic began. A little bit higher than October of 2016, higher than June of 12, higher than December 2008, which was the bottom, or 2 months before the bottom of the financial collapse. Going all the way back, really, we have to go to March of 2001 and July of 2020, or July 2000. Again, that was the bottom of the tech bubble. I just talked about the last time we were here was right here. I called the bottom. That was the bottom of the pandemic. 2016, it ended up bottoming right about it. That number came in here, but we bottomed right before that. And you can see on this chart here in 2016, it was elevated very high already. It was already elevated all throughout that. And then we peaked in October of 2016. But again, that peaking in 2016, right before that, great buying opportunity. We go back to 08. Obviously, we know what happened there. We bottomed early March 2009. Then we go back here again. Oftentimes, when there's this much cash, and it's crazy to think that the fund managers are the ones that are wrong when they move the cash. And I talked about last week at the same time, and this number that came out is the highest allocation ever towards commodities at 33%. That money will not stay in commodities forever. So a big hunk of that's going to flow into equities as well, non-commodity equities and non-commodities into the stock market. It's going to come out of cash into the stock market. So we're looking at a huge amount of cash that, again, doesn't come in 4 days. And that is typically why you will see, and that's why a lot of these match up, because you're going to see this happen, and then you're going to see follow through. You're going to see this follow through in the months ahead. One more chart I want to show you, and this came out of the same survey. And this shows the percentage of overweights and underweights of these same managers towards technology stocks. Boy, it's almost always overweight by a big amount. I mean, usually the average about 35% or so. Look where we hit. This was February's number, actually. Negative. Last time we did a negative allocation towards tech, get out. December 08, again, right before the bottom of the great financial crisis. And again, going back here, same times. We had a sell-off at 03. We had obviously the tech sell-off here. Look how underweight it went, nearly 50% underweight. So folks, I mean, this is not rocket science. It is using a contrarian view. It's looking at the markets through a way where we're not as worried about the day-to-day. We're looking for where the big allocations are and what's moving in the market during those allocations and what has happened in the past when we've been in these situations. So I talked yesterday, just talked a moment that heading into yesterday, we've been up 4 consecutive days, at least 1%. And we actually were up early yesterday, too, to follow through the buying came. And then the Fed chairman, Jerome Powell, came out midday, and he said, quote unquote, inflation is much too high. He also alluded to the fact that he could potentially have a 50 basis point hike at some point this year. Most people think we'll probably have about 5 to 7 25 basis point hikes. And we know last week was the first time that they raised rates in several years. And they raised it by 25 basis points, which again means they raised it by 0.25%. Heading into that meeting, the range of the Fed funds rate is what it's called, was between 0 and 0.25%. It's now a range between 0.25% and 0.5. So we've raised it a little bit in that time frame. Let's take a look now at a chart of the 10-year yield because it moved last week on that news and it continues to move. You can see here it shot up from 2%. We're now at 2.386%. So let's call it 2.39. This is the highest level we've seen in several years. And Powell's comments yesterday really gave it a big boost, as you can see, people thinking that it's going to continue to move higher. I'm going to show you a bit longer term chart to give you an idea of where we're at. This is the highest level we've seen going back to middle 2009, but I'm going to zoom out even further here and give you an idea of where we've been. This is going back to 1994, folks. We're really kind of at the top of that downtrend line. We spiked up once before in 2018, then sold off obviously a little bit, and then the pandemic hit. So we're coming back up. So the top end of this line is around 2.5-ish. So that might be a level that we see a bit of resistance. And if it hangs around up there, maybe there's a point where rates just kind of price in a lot of the rates that are coming, which again, the market itself, I believe, is priced in a lot of that stuff. So what has gotten hit during this time, during interest rates going up? It's been the innovation high growth stocks. So I'd like to look at the ARK Innovation ETF, ARKK. We could take a look at this chart here. As you can see, it's actually rallied again in the last week or so. It's up about 15, 16% or so in the last week. Again, in a downtrend. So this may be a bounce that continues the downtrend. I don't know. I think a lot of the stocks in this ETF are great buys here. I don't think the overall ETF is a great buy necessarily because there's too many other stocks in there that I don't want to own. And that's why we build our own baskets here. With my subscribers and my newsletters, we would rather buy our own basket of stocks in the companies that we feel will outperform. So again, just giving you an idea of what's going on there with the markets. And again, overall, I still think, I don't know if I buy with the market up huge in the last week. We may have a bit of a consolidation pullback in the very short term, but long term, there's still some great bargains out there. Very, very great bargains. So I'm not picking and choosing that. I buy for long term. I bought a stock yesterday for myself, a very small stock, and I continue to buy on all these pullbacks, folks. So let's talk oil here for a moment because, oil had a huge rally with what was going on, obviously, in the markets or in overseas. And then we had a bit of a pullback. So the price of oil spiked up to about 130. Then we pulled all the way back to the mid 90s. We were up yesterday. We're down a little today, about $4, down about 108.66 right now for the price of West Texas Intermediate crude, WTI crude, which is the oil price that we see here in the United States, around 108.50, let's call it. So it's been all over the place. But what I want to show you, Brent crude is the crude that they use for pricing really in the rest of the world, especially Europe. I have a chart here that shows Brent crude price per barrel going back to 1970, right before the Arab oil embargo and before, obviously, the Iranian Revolution. And it shows the price on the chart, and the price is in the little black dots. And then you see in orange, it's the inflation-adjusted price. So the price in today's dollars. So even though we were spiking recently up to about 130, we're still well below where the price was during the Arab Spring, which inflation adjusted is around 155 or so. The Great Recession or Great Financial Crisis, whatever you want to call it, where it spiked up to close to about 180, 190 a barrel, inflation adjusted. Even if we go all the way back to the Iranian Revolution, it was above 150. And, the oil embargo shot it up from basically single digits to nearly $100. You can see on the left side of that chart. So when we talk about prices and commodities like this, we have to take into consideration inflation, because inflation over time, prices will go up. So inflation adjusted is a great little chart to look at it. So we haven't broken to highs yet, not even close, really, if you look at inflation adjusted. Just something I wanted to pop out and show at you, because I think it's important to always think about prices compared to where they were. But at the same time, we want to put that in the correct perspective, which, of course, is you have to look at inflation because prices have gone up, obviously, since I was born in 1976. So that's where we are with oil. It's tough for me to run in and buy oil stocks right now just because they've had such a run up. And I will show you the oil ETF here real quick. This is the XLE. This is the big oil ETF. Follows the pattern we've seen in oil, where oil spiked to 130 here. Like I mentioned, we pull back to the mid-90s and then bouncing back a little bit today. If you think this conflict over there gets worse and worse and something happens with China or Iran, maybe you buy into it. I just think it's a tough buy here based on valuations, based on where we are. I think you're going to see more supply coming on here soon, probably pushing prices down. That being said, I'm going to counter-argue myself that I think that we'll continue to see the global economy open up as the pandemic basically push it to the side and people are getting back to normal. I was on 2 planes in the last week. Each plane was 100% full. And that tells you something, because prices have gone up a little bit to fly, with obviously prices going up with fossil fuels. It makes jet fuel more expensive. So, of course, airlines will pass that along to us as their customers. So we've seen that go up and people still continue to fly. Studies have come out and surveys just in this week alone, just showing how many people globally, not just here in the United States, are preparing to fly in the next year. It's great, and I love to see it. I have tons of work trips planned. I'm going to be on a plane so much in the next couple months here. So I see it firsthand, and I got to tell you, airports are getting busy. As I mentioned, planes are getting packed. It also, I wasn't planning on talking about this, but it does bring me to the airline stocks and travel stocks. And you can see here, this is JETS, JETS. It's the U.S. Global JETS ETF. So it's a basket of airline stocks. It's had a big bounce from 17 2 weeks ago up to 20 and a half right now. So that's a big move. You're looking at nearly 20%, high teens in just 2 weeks. And it was beaten up, obviously, with everything that happened in conflict in Ukraine. So it got hit on that. But I think there's still a lot of opportunity here. The one asterisk that has to go next to the airlines right now is obviously increased fuel costs, because their 2 biggest expenses obviously are overhead with their employees, and then you have to look also at jet fuel costs. So those are 2 biggest expenses, and when you have one of them really spiking, it could hurt their bottom line. But again, if oil turns around and goes the other way and economy continues open, this would be a boom to this industry. So keep that in mind. And then one other ETF, which I've talked about a couple of weeks ago, this is AWAY, Away. It's a travel tech ETF. Again, rallied from 20 up to 23 and change, so up the high teens in the last 2 weeks percentage-wise. This would be, again, another one that does really well as travel continues to come back, not only in the U.S., but globally. So let's talk about China. I saw the stat the other day, and the Chinese stocks have been really volatile, big up days, big down days in the last couple of weeks. And I talked about it when they got crushed last week, and then they rallied back on Thursday. So After the NASDAQ peaked in March of 2000, it fell 78% to its low in October of 2020. So it took 31 months to fall 78%. So this is fascinating. I talked about this last week. KWEB, KWEB. I'll pull up the chart in a minute. That is the Chinese Internet ETF. From its high in February of 2021 to the low of last week, it fell 79%, yearly closer to 78% drop in the NASDAQ. But it took only 13 months. And I've been saying this for years. Bear markets these days are going to be so much faster because we have so much information and it's so easy to sell. You hit buttons, you panic, you get out. It's just so easy to sell and get out. There's so many ETFs that people sell their ETFs. That means the stocks in there get sold, and it's just this vicious cycle of selling beget selling. And don't be wrong, these fund managers panic just like the rest of us. Because the only way they don't get fired is if they do worse than the guy across the street or the girl on the other side of the street. So they all sell. They're sheep. They all do the same thing. That's why you see the cash level spike like it did. That's why I see so much money going to commodities at one time. They're sheep, just like a lot of other unsuccessful investors. So KWEB, let's take a look at this ETF, how it got crushed, and then huge rally back. I mean, huge. Some stocks were up 60, 70%. Unbelievable, the gains that we saw in some of the Chinese internet stocks. And if it closes where it's at today, it'd be the best close in about 2 weeks. This morning, one of the top holdings in the ETF is really moving. And this is Alibaba. It's up over 12%. They announced a major stock buyback this morning, so it's up on that, and that's up to nearly a 1-month high. I mean, Alibaba was in the mid-70s, up to 116. I mean, I look back and I'm preaching this stuff, folks. I'm saying it's down here. It's a great buy. It could fall to 50, but it could back to 250 before you know it. And I didn't buy it. I'm guilty too. I keep buying up other stuff. I didn't buy any Alibaba. I'll be honest with you. I have a friend who owns it, and I said, do not sell it. But my God, 75 to 116. Up over 50% in one of the largest tech companies in the world in 2 weeks. Fascinating. Unbelievable that what we're seeing. So I look at the Chinese internet stocks and they're not going to go straight up. If there's any type of pullback or weakness or profit taking of the short rally, my God, I think if you're okay with owning Chinese stocks, and you should be, what great opportunities that we have down here, folks. Next topic I want to talk about is Goldman Sachs. Obviously, we all know Goldman Sachs, right? They became the first bank to trade cryptocurrencies over the counter. So what they did is they announced they traded a Bitcoin-linked instrument. They call it a non-deliverable option. It's very confusing, but I'll get to the point here in a second. They traded with crypto merchant bank Galaxy Digital, which is a publicly traded. I'll show you that stock in a minute as well. So now what happens, Goldman now is they're acting as what's called a principal. They're in the middle of the trade. And they do have some products on the Chicago Mercantile Exchange, the CME, that they traded last week, but these are a little different, where they're actually acting as a principal. So what this does, it allows for their clients to have a direct exposure to the crypto markets, and they can customize this, in different ways. So this is really big, especially for the high-end clients that have been knocking on the door and saying, I want exposure to cryptos. What this move is big, because what this means is if Goldman does it, JP Morgan, Bank of America, everybody else is going to be doing it. So Goldman actually came out and said, we're pleased to have executed our first cash-settled cryptocurrency options trade with Galaxy. And they believe that this is the next step is an options market, like a true options market when it comes to cryptocurrencies. So this is big news for Bitcoin. And Bitcoin really hasn't done too much here recently, but it's got a nice bounce in the last couple hours or so. In the last 24 hours, it's up about 4.7%. It is at the best level that we've seen in about 2 weeks. It's at 42,965, so just below 43,000. If it breaks above 44,500, which it could easily do this by the time this video comes out, that's a triple top, if not a quadruple top on the chart. That would be a really nice breakout. And Bitcoin right now is forming what we call an ascending triangle, where we kind of have that flat top around 44.5, but every pullback has been at a higher low. So imagine an ascending triangle, flat top, bottoms coming up like this. It consolidates. Typically, if you break above that upper level, it's one of the most bullish charts you'll see. And it means every time it pulls back, it's at a higher price because people are willing to pay more for it, meaning buyers are accumulating at a higher price, which is obviously very bullish. Like, again, charts just show psychology, folks, of people. The break above that would be fantastic. We just ticked above 43,000 right now as I'm talking. So I think that we could see a major breakout here in a short term in Bitcoin, which would run us well above 50,000 if that happens. So I think you're getting ready for a nice consolidation breakout coming in the crypto markets, especially in Bitcoin. So the last topic I want to talk about, and this has been one of my favorite megatrends, if you will. And one of my newsletters came out today, or last night after the bell, and it is all focused on megatrends. And Megatrend Investor came out, and I recommended a brand new small cap battery related stock last night. And it's a stock a company I've been following for a while since it went public, and it's just ripe. It's such a niche play. And I think it's ripe for a really big move in the next five plus years. So we recommended that last night. But speaking of batteries, Barron's tracks a basket of metals that go into lithium-ion batteries. And so far through 2022, so year to date, this basket is up 64%, believe it or not. So obviously a lot of this has to do with nickels had a big run. We've talked about that. Cobalt prices have been up really big. Lithium obviously goes into it as well. So this basket that it has, it just continues to move up. And yeah, a lot of this has to do with what's going on in Russia because, obviously over there are some issues with nickel supply. So we've seen that. And let me show you the chart of the ETF here that tracks nickel. And, we had that huge spike about 2 weeks ago. And I said, this is crazy. This is a bubble. And we pulled back. We continue to pull back. But that being said, this is trading at 38.62. If you go back just to late 2020, it's trading at $20. So it's still up nearly 100% or so in that time frame in about a year and a half. So it's still well up. I mean, the huge spike up there was just a bubble. That was not normal. Weird things were going on. People were messing around with the nickel market because it's not that big of a market. What does that mean? Well, what this means is, according to Barron's, theoretically, that raises the sticker price of the average EV, electric vehicle, by as much as $2,000. So this is going to force, and it's been this way for a while, but it's going to force auto manufacturers, battery manufacturers to look to alternatives outside your traditional lithium-ion battery. One that I've talked about, one battery technology that I think will come to fruition in a large-scale way, will be solid-state batteries. And there's been a couple companies that have gone public in the last couple of years that are focused on solid-state batteries. I also think that we will see some other iterations of lithium batteries. So there's a company by the name of SES. It's a battery technology company. And they're developing batteries that have pure lithium anodes. So to give you an idea, anode is one side of the battery, and the other side is called a cathode. Okay, so the lithium-ion battery anodes are typically graphite, the ones that we have today, and the cathodes are the sides that use metals like the nickel and stuff. So if you look at a pure lithium anode, not only does it boost the energy density of an iron-based battery chemistry to make it comparable to nickel-based cell, which is important because a lot of these alternatives right now, you lose some energy density. It means your range on the vehicle won't be as far. So that's very important. So SES, again, newly public company, nothing commercial here yet. There's no even revenue estimates for the next 3 years, which means they're a little far away from actually producing something that's going to actually make money. But the fact that nickel's gone up so much and they're looking to use something without nickel, you've seen the stock go up. So let me show you a chart here of the stock, and it's symbol SES, as I mentioned. And you can see, it went public and then it was around $8. It fell down to $4. And in the last month, less than a month, 2.5 weeks, it's going up to $8. It's at $7.74 today. So it basically doubled in the last 2.5 weeks. I'm not recommending to buy. I'm not saying anything about that. Again, nothing on here and on any of my shows are buy or sell recommendations. They're all ideas to get your brain thinking. Again, the 3 things that we're trying to achieve here in every single show and everything I write and everything that I do when it comes to my investing and trying to reach out to everybody in the world. We want to educate you, and this is education right here, and I have to show you the stocks because that's important. We want to have fun, which I think we do have fun. And then number 3 is to make money. So again, for my subscribers that pay, that's where we give our actionable recommendations, and we help you get out there, and we tell you which stocks that I think and my team come up with that are the best buys in these mega trends, such as batteries. We recommended a battery company last night, as I mentioned. There are 2 battery ETFs. I don't like them necessarily, and the reason I don't like them, folks, is because they tend to have what we call style drift, meaning that some of the companies in there deal with the batteries themselves, but they end up being in other companies that are kind of indirectly related to batteries. So here's the first one. This is the Amplify Advanced Battery Materials and Metals and Materials ETF. So if we take a breakdown of BAT, you can see that the allocation is, again, there's some exposure here to pure battery companies, but a lot of them will be companies that are secondary plays at best, to be honest with you. Take a look at the holdings here. I'm going to pull it up for you. BHP Group, which is BH Billiton, I should say. Used to be called that, but now it's BHP Group. 7.6% weighting. That's a metals play. Tesla's number 2 at 6.7. CATL, which is the largest battery maker in the world based out of China, 6.1. Love that company. The only way to buy it is if you buy it through the Hong Kong exchange, or if you get it through an ETF. Glencore, that's in there, that's a materials company. BYD, that's a Chinese auto manufacturer plus battery maker. Yunnan Energy, which is another Chinese company. Lucid Motor, Rivian Automotive. So it's a mix. It's not a pure play in batteries. So that concerns me a little bit. And again, there's some companies in there I love that I just mentioned on that list. There's some I actually love, and there's some I don't like at all. Then the other one is the Global X Lithium and Battery Tech ETF. A little bit different chart, a little bit different performance, and I'm going to come to that in a second. But the holdings here are completely different for the most part. Albemarle, which is ALB, which is a huge lithium company, makes up 10.4%. Tesla, number 2, just like the other one. Then we have TDK, which is a Japanese company. CATL, Yunnan Energy is in there. SQM, which is a Chilean lithium company. Panasonic, Gafeng Lithium, which is a big lithium company in China. BYD's in there again. EV Energy, another Chinese company. So a lot of exposure to China because they're obviously big players when it comes to battery. A Japanese company in there as well. A couple of Japanese companies in here as well if I'm looking at the list. Samsung is in there as well. But again, you're not getting that pure play battery. And that's why in both of my newsletters, we have battery stocks that we recommend that I believe you build your own basket. And it could be between 3 and 5 stocks. Evenly, so the way I look at it is if you say, well, Matt, I want to put $500 or $5,000 or $50,000 into the battery megatrend, and I'm going to go buy LET or BAT. Now, I think you could build your own basket much better, and that's what we do. And keep in mind, it's not huge, but this day and age, we can buy and sell stocks with no charge. So if we're putting 500 into our battery megatrend basket, all 500 goes in. Say it's 5 stocks, $100 each, no commissions, nothing. If you buy an ETF, there shouldn't be a commission either. However, they do charge an expense ratio. LIT, for example, has an expense ratio of 0.75% a year. So whatever you're making, take that off. BATT has an expense ratio of 0.59%. Whatever you're making, take that off. Again, it's not huge, but over time, it makes a difference. And if you do it yourself and create your own with no fee, even better, folks. So you look at the performance of the two versus each other, BATT versus LIT, and it's been really quite different. In the last 3 years, the Global X Lithium, which is LIT, is up 162% in the last 3 years, where BATT is only up 29.5%. So again, this goes to battery, they're both listed really as lithium and battery tech ETFs. The names are almost exactly the same. But one is up 29.5% in 3 years. The other one's up 162% in 3 years. It's a hell of a difference. I mean, let's put this in money. If you invested $10,000 into BATT, you'd have $12,950. It's called $13,000. Not bad in 3 years. If you invested in LIT, you'd have $26,200. That's a big difference, folks. It's a difference of over $13,000. Doubling what you would have had if you're just in BATT. So I'm not saying one's better than the other going forward. My point is, what I'm trying to make is, when it comes to ETFs, when it comes to this type of stuff, just because a name says battery, says lithium, they're all different. And a lot of times, again, whether there's 25 or 500 stocks in the ETF, you have to realize that you may not want to own all of them. And you have to really build your own. And again, that's what I do, and that's why we're here to help you. So before we wrap up the show here today, let's take a look at the S&P 500. When we started the show, it was up about 0.8%. It's 10:43 East Coast time right now. We're up nearly 1.1% near the high of the day. Again, 1 month high here on the S&P 500. And let's take a look at the QQQs, which is a NASDAQ, a little more tech heavy, up 1.75%. Again, very close to a 1 month high. Man, oh man, what a rally we've seen here. And folks, I'm telling you, I've been pounding the table in the last month and a half here where, stocks were really near these lows saying you do not sell, number one. Number two, we should be buying down. There's so many great bargains. I've been buying. We've been recommending stocks. We went out with my inevitable portfolio just over a month ago. It was on the 18th of February. People thought I was crazy coming out with a portfolio then. I got to tell you, I think in 3 to 5 years, that portfolio is a double, triple, if not more. That's a basket of 10 stocks. All of them being up in a couple of years? Probably not. I'm realistic. But I feel like there's going to be a couple huge winners in there. And the great part is almost all that portfolio, except for maybe one, are still great buys. That's the great thing about this. There's still opportunity. Just because markets have gone up in the last week and a half, there's still opportunity. So don't let the crazy ups and downs and this volatility scare you away. We're here for you. We're here to help. Thank you so much for watching, folks. Once again, this is Making Money, and I'm Matt McCall.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.